Hi there, it's me, Stephen Thomas, with Reports on Housing. And we're coming to you on a Thursday this time, Thursday, October 16th. That's actually when I like to do the recordings, but we've been so busy with recent presentations, we actually launched our 2026 forecast tour. And if you're a real estate agent and would like to for us to present to your office, have your manager or whoever's in charge of your meetings contact us, and we'd be more than happy to try to accommodate that. And you can reach us at office, OFFICE, at reportsonhousing.com. But this week we're diving into a new housing debrief, and this week's topic is inventory surge. Are sellers realistic? So basically, the inventory picture has been changing over the last couple of years. And really what's behind the scenes, you can actually see it here. You can see that this is from 2022 to where we are today. And from 2022, things have really gone up. Across the United States, we've been building an inventory. And it's not all markets, but the Northeast doesn't have as much inventory, but the rest of the United States and the upper Midwest doesn't have still a lot of homes on the market, but the rest of the country really does. And the inventory has been building. And really what's happened is in 2022, we had rates that went all the way from 3.25% to 7.37% by the time we got to October of 2022. And that really slowed down the market. I mean, all of a sudden we saw a waterfall dive in the number of pending sales, and that translated to a waterfall dive in the number of closed sales. And then in 2023, we had very few homes come on the market as a result. Everybody had either refinanced or purchased their home at very, very low rates. And so once rates were all the way up into the sevens, a lot of people they were going to sit tight to see when rates were going to come down. And then very few homes came on the market. So that was this lock-in effect that so many people talked about. And in 2022, you could see the inventory in 2023, you could see the inventory was really, really low. And that was very few homes that came on the market. So each one of those hills is a year. And the first hill is 2022, when rates all of a sudden, we saw inventories rise like crazy because people were expecting values to continue to go up and sales to continue to go really fast. In 2023, very few homeowners came on the market. And even though we had low demand, we had very few homeowners participating. So we were unable to really build an inventory. Then in 2024, that was last year, we actually started seeing more homes come on the market than 2023. People were getting tired of waiting. How long are they going to have to wait before rates come down into the fives or even lower? It's going to be a very, very long time. So more people came on the market and the inventory began to build. That's the third hill over on the right. Now, this year, you could see how high the inventory level has climbed, and that's 2025. And we see a lot more homes on the market in 2025, and that is because even more homes are coming on the market than last year, and which is way more than 2 years ago. And the inventory was built. And demand has not really changed that much from year to year to year. So as a result, with these extra homes coming on the market, they were just accumulating, and that's how we've been building the inventory over the last couple of years. And you could see it here. This is the blue line is 2023. Like I said, very, very flat. And then in 2024 is the purple line, and in 2025 we have the red line. And you could see how the 2025, there are a lot more homes than the last couple of years. So you have this inventory that has been growing, and demand has remained extremely low, and that's because of an affordability issue. And you can see that affordability issue translated into the number of pending sales. On the right-hand side, each one of these, once again, each one of these spikes up and down is a year. And this thing goes way back into time. As a matter of fact, this one is from 2001 on. Now, on the right-hand side, you'll see three very similar looking low mountains, low hills. And those are 2023, 2024, and 2025. And the fourth one over from the right was 2025. 2022. So there were a lot of transactions taking place, number of pending sales, but then it began to drop as rates continue to climb, and it really got low. And that's where we've been. We've been at these low pending sales levels now for over 3 years. And this shows you where demand is, the pending sales. This is a pending sales index from the National Association of Realtors. And you can actually see this, that 2023 and 24 and 25 are pretty much like on top of each other. That's the red, purple, and blue lines. Now that green line is the 3-year average number of pending sales that were prior to the pandemic, 2017, 18, and 19. And if I was to even show you what this pending sales index was for like 2021, it was higher than that green line. So it was even higher than that. So pending sales activity is very low. We have very low demand, buyer demand, and it's because of how high rates are. Home affordability has totally eroded, so the number of pending sales has definitely gone way down compared to what the real estate market is used to for many, many years. As a matter of fact, this is the lowest level, the pending sales index. When you go back, it really wasn't stuck like this for several years during the Great Recession. There were still homes that were sold because there were so many foreclosures, short sales, and distress, and people that had to sell, and that we had values that were coming down. So it encouraged a lot of buyers to purchase during those years. And this is where we've gone in supply. And you can see the elevation. This is from 2021. In each one of these like little bumps is a year, 2020, 1, 2, 3, 4, and 5. And you can see that the amount of supply, the month's supply, has been increasing over time. And we like to translate months into days on market, because when you talk about months, when you're approaching 5 months, doesn't sound like that much more than 3 months. But there really is a difference when you translate it into days, because 5 months is 150 days. 3 months is 90 days. And when that's how we like to articulate it. So then what we've done is taken this is the market time index that the National Association of Realtors provides, and we translated it into days. So this is the amount of supply, not in months, but days. And you can see this days of supply. The red line is this year compared to even the 3-year average prior to the pandemic is the green line. And so it is slower than where we were prior to the pandemic. It is slower than last year, the purple line, which kind of danced just a little bit above the 3-year average, but then came below. And the blue line was 2023, and that orange line was 2022. So you could see how fast the market was moving. It was less than a 60-day market. That's less than a 2-month market. And in many, many markets, we actually saw it get down into the teens. And you could see how it slowed as interest rates rose in 2022. And it's been stuck at these higher levels, but slowly but surely, as we've been adding more inventory and demand hasn't changed, the speed of the market, the supply based upon days, has been going up over time. And so, but a lot of people are asking, so why aren't prices coming down if demand is so low and the supply is increasing? Why don't we have prices that are really coming down? And it really does boil down to supply and demand. It's like Econ 101, supply and demand. And what we've had is a very, very low supply. And we've had at first, and then we had very, very low demand, and you match those up against each other, and that's that supply and demand. But what's happened is slowly but surely there's been more supply that has been thrown on to the supply side. And at first, when we went into the higher rates in 2022, we saw values across the United States starting to go down. But then in 2023, with very few homeowners coming on the market, we actually saw overall across the United States, we saw values that were going up. And in 2024, the values are going up, but not as fast. And in 2025, it's more of like this evenness between supply and demand, where right now it's very, very close to where everything is balanced in the marketplace. Some markets are a little bit more out of balance, so prices come down a little bit more. Some markets are a little bit more heated, that favors sellers, and values are going up a little bit higher. So it all boils down to, so house prices at first went up. People didn't understand that. And you have to look at it here, and you can actually see that you could see on the right-hand side, you could see where it went up during COVID, the pandemic, but you could see where the values went down for a few months. But then you could see each one of those years is 23, 24, and 25 is on the right, where it's been pretty flat, negative to up on a monthly basis. And so it's been relatively flat. It's up 1.2% is what it's right now. That's the annual home price growth rate right now. So year over year across the United States, it's only up 1.2%, which means that the market is more in balance. But you have to understand that across the United States, different markets are behaving differently. And you can see on the West Coast, where I am, that it's pretty flat to down 0.9%, and that's San Diego County. Orange County, it's up 0.1%. And only in San Francisco, the county of San Francisco, is that up down 2.3%. But and you can see on the upper right-hand side where you have the Northeast and you have the upper Midwest where values are going up, and that's because of the supply and demand, that there's still not enough supply there. But then you go down further into Florida, and you could see where there are a couple of markets, and some of them are really small markets that are going down, and those are the ones that are getting all the press, like as if the rest of the country is going to go this way. Now, the forecast for these markets is not for them to continue to slide down. As a matter of fact, Florida's inventory is starting to come down. Where they think the problem's going to be is actually in Louisiana and Mississippi and right around those Sunbelt states. So, but it's not across the United States where we're going to get this issue. So let's talk further about, okay, why aren't we having prices come down more? And we're going to dig into a little bit of supply. But first, we're going to get to our sponsor. And our sponsor is Angie Sandoval. You'll recognize her with JMJ Financial with the Thibodeau Morel Group. You can contact Angie at 310-418-9722. And they've got this great program called Buy Before You Sell. That's where you buy first, sell later, move with confidence. And basically, for most homeowners, buying a new home while living in their current one feels impossible. Sell first, and you might be stuck without a house. Buy first, and you might not qualify for both mortgages. Well, JMJ Financial changes that. So they have this program, and basically they have a guaranteed backup contract with you can go non-contingent and compete like a cash buyer. You qualify for your next home without counting your current mortgage. You make a non-contingent offer with full confidence, and you get up to 6 months to sell your current home after closing. And it's like a cash offer program. Turn your offer into cash and close fast. Make a true cash offer and close in as little as 10 days. Borrow up to 95% of the home's value. There's no monthly payments. Interest accrues and is deferred until it's paid off. And instant equity program, unlike your home's equity before you sell it, use funds from your current home to buy your next one now. Available in first or second position. Deferred payments with accrued interest. So if you want more information on this exceptional program, you can contact Angie Sandoval. Work with a lender you can trust at 310-418-9722. That's 310-418-9722. Now back to the program. And so what's going on with the inventory? I want you to understand you have to take these graphs that I showed you, because this is what a lot of different YouTube channels do. They take things out of context. Everybody right now intuitively knows that the number of homes are coming on the market. It's continuing to come on the market. There are more homes now than there were last year, than there were the year before that, and then there were to start out 2022 when we had the fewest number of homes that came on the market. And you can see it here. This is also from the National Association of Realtors. I showed you a little snapshot that just goes back a few years, but you could see over time that this is actually, yes, we have a lot more homes on the market than the last few years, but in the context of time, we don't have a lot. Matter of fact, we've already peaked out in the United States as far as inventory is concerned, and it's going to go down from here. And this is still not enough homes on the market. If you look to the left, this goes all the way back to 1982. And you could see up here, this is where we were in 2000. From 2000, you could see it was starting to grow in 2005. And in 06, 07, and 08, it nearly hit 4 million homes on the market. There's just a little bit over 1.5 million homes on the market right now. So there were a lot of homes and a lot of people that were stuck in their houses, that they couldn't make the payment. They were short sales, they were foreclosed on. There were a lot of forced sellers, a lot of people that got into pickles and they had to sell, which is what's absent in today's market. There are some people that definitely still have to sell, but they are actually the minority in today's market. So as a result, were a lot more homes on the market. And back then, there were a lot of foreclosures and short sales. So these are banks that had to unload the properties in order for them to clean out their books and actually recoup the money that was now stale, and they weren't making any money. Matter of fact, when a bank has an asset, where a house, they have a loan, and that loan is not performing, they actually, once it starts going to the foreclosure process, they have to have more money in reserves so that it covers this now negative asset. So that's why they want to unload these properties. But we don't have that. The national delinquency rate is stuck at very, very low levels, and we're not going to get a lot of foreclosures. You can watch last week's Housing Debrief on the lack of foreclosures and how we will not have a wave of foreclosures. And you could actually see, so this just shows you that I showed you this. This was the amount of supply that we had. And you can see this year, yes, over the last couple of years, we have a lot more homes on the market. But you got to take it in proper context. This is where we are as far as the number of homes on the market, even compared to the before the pandemic, the 3-year average before 2017, 18, and 19. So we still don't have enough homes, even compared to where we were prior to the pandemic. We're making our way back up to it. But now there are fewer homes coming on the market. And a matter of fact, right now it's matching where we were last year. So we were placing a lot more homes on the market than last year. But real estate's has had so many clickbait negative news articles that are out there that people believe that the market isn't that great, which it's not hot, but it's actually not caving either. We're not going to get a crash. So you can see that it's actually stalled out. We've actually peaked, and it's going to start to go down for the remainder of the year. Now, this year, compared to the 3-year average, it's still lower. And if you want to compare it to where we were in 2006 and 2007, when there were 4 million homes on the market, that's the green line and that orangish color line. It is way more homes on the market compared to where we are today. So that's where you have a glut of homes versus nothing on the market. And so what's the overall speed of that market? Remember, this is that supply. National Association of Realtors calls it the months of supply. We translate it into the days of supply. And you can see where we are right here. Yes, we are higher than where we were the last several years, but proper context, once again, you could see where we were compared to 2008, when it took a year to sell homes versus where we are right now, where it's not even at 150 days. So it was twice as slow, with a lot of foreclosures and short sales and people that had to sell that were in pickles. And right now there's a lot of homes that fewer homeowners coming on the market, and a lot of homeowners that were sellers that are coming off the market. They're delisting their houses. They're pulling them off, throwing in the towel because they have not had success, and they'll either wait till the spring of next year, or they might change their real estate plans based upon the way that the market is moving right now. So you have to understand good old-fashioned economics 101 and supply and demand. And I told you about the balance scale right now, where we actually are at a different spot than what a lot of people think. And that is because today, rates, this is Thursday, October 16th. There's a problem in the banking sector right now. And as a result, we watched mortgage rates go down a little bit today. And now they've dipped below 6.25% to 6.23%. And we have now been below 6.5% since September 3rd. And that is you could see this is actually the last year's worth of interest rates. We are at the lowest, this lowest range in a year, and we haven't had these rates since they were October of last year. After October 3rd, they started to climb, and year over year, you could see where rates were headed. They were headed above 7. We started out this year above 7, and it's been relatively high until recently. We could see that rates have really made their way down from about June of this year all the way to where we are today. And you can see that trend, and that's because of the overall slowing of the economy. When the economy slows, rates come down. And it's not because of what the Fed's going to do, it's because what everybody anticipates the Fed is going to have to do because the economy is slowing down, that they're going to have to lower the short-term overnight banking rate called the federal funds rate. And so we have spent 43 days so far, counting today, below 6.5%. Last year, from the end of August to the start of October, very start of October, we spent 47 days below 6.5%, and there was this resurgence in demand. And that's exactly what we're kind of seeing right now, is that this is coming late, but we actually see demand levels very similar to where we were last year because of that resurgence in demand. And what it translated to was more pending sales and more closed sales to close out the year. Now these rates aren't going to they're not going to all of a sudden go up. As a matter of fact, once the government is reopened, we anticipate that the different jobs reports that are going to come out and various economic reports that are going to come out are going to show this slow deterioration continue, and we're going to see this slow easing in mortgage rates until we get down to about 6%. Now, if something actually breaks further, then we could actually see interest rates dip into the 5s. And if I was a buyer in today's market, I would actually get somebody to pay a seller that's been languishing on the market to pay 1.5 points, and that will buy down the interest rates to get where they want to be, closer to 5.5% today. So if you want rates at about 5.5% and you're a buyer and that's what you're waiting for, get one of these sellers that have been sitting on the market for a long time and get them to pay points, 1.5 points. It's not a lot. You're talking like for $1 million house, you're talking $15,000 that they have to pay you in order to for you to buy down that rate permanently. So rates looks like they're going to continue to go down, and as soon as everything's reopened up, we'll see them continue to go down, which just means more activity, and we'll be below 6.5% for duration, which is great news, because what that means is we're lining up for a 2026 that will be a lot stronger. So if you like what you've seen, like this video, subscribe to the channel, and you can go to reportsonhousing.com for more information. That's where you can go to subscribe to one of our many reports in SoCal, the Bay Area, and Phoenix, and Vegas. And the most recent report that came out is called Pricing for Success. And if you want a free month, you could utilize the coupon code SUPPLY. So thank you so much for joining us for another housing debrief. I appreciate it. Hope you have a great close to this week, and we will see you on the other side.